Hey, good morning, everyone. Chris Lopez here, and welcome back to our April 2019 Roundup for Denver real estate investing. So we'll go through a few minutes of some market stats, and we also pull out an indicator to dive into a specific stat. Then we're going to cover two case studies today. One is a house hack in Arvada. The other is a rental in Aurora. So for those who don't know me, again, my name is Chris Lopez. I'm a real estate agent here at Your Castle Real Estate, and I focus on helping house hackers and investors buy properties for long-term rental portfolio building. And my co-host is Joe Massey of Castle and Cooke. Good morning, Joe.
Good morning, Mr. Chris Lopez. Great to see you today. As you mentioned, I'm with Castle and Cooke Mortgage, Senior Loan Officer, Branch Manager, wear a lot of hats, do a lot of things over here with financing and real estate financing. And, we focus on permanent residential financing for investors and primary residents, work with a lot of people that are buying their first investment property, their first home, all the way up to their 10th investment property or more. So really excited to be here. Thanks for having me.
Of course, Joe. All right, so we are going to dive into the market stats. And for those who are joining us live while recording this, definitely ask questions. We will be monitoring those. So we love questions because we get going too fast sometimes. All right, so this slide is the data snapshot for last month's data in April. It's a little bit blurry, but I wanted to blow it up to make it really big. So a couple of stats we'll highlight on here is we always like to look at what the active inventory is. Now, this is for single family stuff. So detached houses, condos, and townhomes. So this past April, we just had over 7,000 active inventory.
Can I have the mouse?
You may have the mouse.
That way I can drive while you're talking. Go ahead.
Yeah, Joe and I were talking before, like neither one of us can like talk and type at the same time. We're talking and use a mouse.
Right.
So thank you, Vanna White.
You're welcome.
So active is just over about 7,000 total for this past April. But last April, we're about 5,100 and change. So that's a 35% increase or so. So we like to look at compare month over month or year over year, comparing month to month, because it kind of takes into account seasonality, because the market's very different in April than it is in November between Thanksgiving and Christmas. So it gives us a better barometer to see what's actually going on. Now, if you've been following us, you definitely know we've been seeing a rise in inventory the last like 6 months now or so, or 7 months.
Yep.
A lot of times it's been more like towards 50% increase. This month, it does not seem to be as much. It's about 35% increase. So more inventory, which should not surprise anyone at this point. Now, the next indicator that I think is really interesting, excuse me, is the under contract. Because last month, Jonah actually talked about how the under contracts was actually slightly down from March 2019 to March 18. Well, this April to last April, we're about 6,500 under contracts for this April, and we're about 5,800 under contracts for last April. So that's a 12% increase. And so this is actually what I was expecting to start seeing last month, but I think we're starting to see it now. And Joe, why do you think we're seeing more under contracts?
This is such a lame excuse, but it's real. The weather was kind of crappy in March. It was kind of, I don't know, people didn't want to go out. It's funny. People will stay home. They're like, oh, we'll go look at homes next weekend. Oh, we'll go look at homes next weekend. All of a sudden you're into April, May, June. So it's a lame excuse, but that's what I personally think. I think the weather in February and March was kind of junky. We had the bomb cyclone, all the different snow and miscellaneous, just cold, kind of gray weather. And I think it impacts things. And it's a lame excuse, but it's true. But investors out there, let me tell you, a great time to go look at properties and have no competition when the weather's crappy.
When there's snow on the ground.
When there's snow on the ground, people aren't out looking at homes. Great time to buy properties.
So that was not the thing that come to the top of my mind.
Yeah. Tell me what you think.
And I'm surprised you didn't say this since you're the lender. I think it's because interest rates, we've seen that drop off.
Could be.
I think it's all a bunch of factors. And of course, we get to sit here and guess, and who the hell really knows. But I think it's the interest rates. I mean, they've dropped 3/4 of a point or something since November.
Yeah, November.
October. So I think that's dipped in combination with more inventory. I think it's people that were priced out. Hey, they can come back in the market now, and then people who have been, hey, they maybe put in 2, 3, 4, 5 offers over last year. They got burnt out. They're like, wow, okay, interest rates have dropped again. We got to go out there and buy something and lock it in.
Yeah.
Now, of course, we've bought probably, I don't know, I've helped clients probably buy about a dozen properties in quarter one plus April of this year so far. And no one's mentioned to me about interest rates. No one's mentioned to me about weather. No one's mentioned about more inventory. So I think a lot of investors out there, they really don't care. They're just looking the dollar cost average in there. And the interesting thing is, as I've been analyzing a lot of spreadsheets or deals with people using Joe's spreadsheet, is a lot of my clients have had interest rates that have been way higher than they currently are at the current market, like a half a point, 3/4 point higher, going off of like data from 5-6 months ago. And like, all right, these numbers look pretty good. I'm like, hey, you're right, but I think your interest rate should actually be like a half a point lower.
Yeah.
And they're even more stoked.
Right. And what you mean is they're looking at it, should I buy this property?
Yes,
and they're plugging that in, and then we're able to give them good news that, hey, you were calculating this at 4.75. It's actually 4.25.
Yeah.
And so it makes it even a better deal.
Yeah. And so that's, it's like, oh, cool. This is even better now because it's just better margins on the cash flow. And of course, since we do a lot of house hacking stuff, margins are tight when you're putting 5% down.
That's right.
So the other thing I wanted to look at was the days on market. So I'm actually going to pick the median just because that is the biggest percentage increase. If you look at days on market, in April of this year, we're like at 8 days on market. Last year, we were at 5 days on market. So that's the median. So that's a 60% increase, which sounds horrific.
That's terrible. The sky's falling.
I know. But when you're still in the single digits, and of course, this is the median we're looking at, that's still ultra, ultra low.
Yeah. I mean, the difference between 5 and 8, yes, it's a 60% difference, but you're barely even more than a week on the market. I mean, that is not something to panic about. Now, headline, days on market increased 60%. Oh my God, the real estate market is coming to a halt. I could see somebody spinning that, but it's not true. 5 days to 8 days, that's fine. That is just fine, guys. Nothing to be concerned with. And
I actually attended Lon Welsh's, one of his real estate trends class a few days ago. He's brilliant data mine when it comes to stats in the Denver market. And one of the slides he highlighted was actually talking about some days on market. And I forget the exact stats, but here's a gist of it. If houses are priced correctly, and that is meaning that there is no price drop from when they were listed. So the house is at $400,000, and there's no price drops when it goes under contract. It was priced accurately. Now, if it went from 400 to 390, that's considered overpriced, and there was a price drop. So for houses that were priced correctly, it was something like on average they went under contract in like 13 days or 12 days. It was very, very low. Now, if the house, or I should say the property, was overpriced, it was closer to like 58 days. It was about 4 times longer. So it goes back to, hey, if you are marketing or if you're actively, I can't talk this morning, if you are accurately pricing your property that you're selling or that you're listing, if you're an agent, you're going to still sell it relatively really quickly. So a lot of times we focus on, we're buying investment properties or this property's been in the market for 30 days or longer because there's usually more wiggle room in the price and people stop looking at them. So moving on to one of my favorite charts. This is the active listings over how many homes were sold per month. So it's just a big graph. So the orange graph is the active listings. The blue line on the bottom is the homes sold. So this always takes into account the seasonality we've been seeing, where there's more inventory this time of year, and then the inventory drops off as we get into summer and fall. Now, looking 10 years ago, tons of inventory, and we're looking at our current last about rolling year. And the active inventory is definitely creeping up some, as we've been talking about, looking at the numbers and percentage wise. But when you take a step back and look at this graph of the last like 10 years or so of data, the inventory level we're at is actually still really, really low compared to the big picture. It just is a lot higher than we've been seeing the last 3 years. So this is a good big picture or good context in the big picture of things. So any concerns on the market? Or what's your thought on this chart right here, Joe?
I want to comment. I taught a class last night, and one of my favorite questions that we get is, are we in a bubble? And I think this chart is so good to answer that. We can get into the stats, we can get into the data, but I love to just have a visual representation right here. This is like 2010, 2008. All right. The bubble burst like right here. See this difference between the number of listings and the number of under closings?
We were about what, 25,000 listings to about 5,000 sold.
Yeah.
It's about 20,000 difference.
This big gap right here, this is a bubble. This is a bubble that there's way too many homes listed, not nearly enough transactions occurring. This over here, this gap is very small. This is not a bubble. This is simply supply and demand, that there's a lot of people that want to buy homes, not a lot of homes listed. That pushes prices up. Now, inventory is increasing a little bit, but this is not by any means a bubble. This, guys, this is a bubble. At some point when we're doing this roundup in the future and we have a big gap like this, then I might be talking about a bubble. All right, especially if home prices are still going up. Now, if home prices are declining in this level, it's not a bubble. That's just natural decline of prices, which is what we saw through this period. So I love this chart because it's just a true representation. This distance here indicative of a bubble. This, not. There is not a bubble in Denver real estate right now. So still a great time to buy property, great time to own property, great time to rent. Don't be worried about prices going down anytime soon, as far as I'm concerned.
I agree. And for those of you that can't see this chart and the other ones we're talking about, just go into your podcasting app, click on the show notes, and it'll take you to a link with all these charts and all the other cases that we talk about if you want to see the data. We try best to describe it verbally, but that is not the same thing as seeing a chart.
Yeah, sorry. I always forget not everybody's looking at the screen. I'm not the sharpest tool in the shed.
So this one here is this chart. So this is actually kind of a different way to look at, are we in a buyer's market, a balanced market, or a seller's market? And this is actually graphing it using months of inventory. So again, we're just using a different metric to look at where we are in the market. And I picked this chart because we saw that, I think it was like a 60% increase in days on market, going from like 5 to 8. So, you know, a huge, huge, huge increase percentage wise. But when you look at the graph here, we are still well below 2 months of inventory. A lot of times in the smaller stuff and lower price stuff, we're below 1 month's inventory in the Denver's market. And you can see here that we are still very much in a seller's market. I think we have about an average, like, I think 1.5 or so right now for the whole market, give or take a couple tenths of a point there. Now, to get anywhere close to a balanced market, we consider a balanced market roughly between 4 to 6 months of inventory. Now, above 6 months of inventory, we are in a buyer's market. So we're actually exactly at 1.2. I'm reading the fine print on the chart here. So even though we're seeing inventory creep up, even though we're seeing days on market creep up, which all build out to months of inventory, we are still very much in a seller's market here.
A strong seller's market.
Exactly. So if you can go back to the 90s here, like 93 to about 2000, we were in a seller's market. We were still bouncing around between like 2 months of inventory and 4 months of inventory. And right now we're at right around 1.2, 1.5. So even if inventory doubles, so we go up to 3 months of inventory, we're still in the seller's market. So what this means to me is what I've been saying for last couple months now, is that the sellers are still in the driver's seat, but the buyers have a little bit more say as to where they're going, and we can negotiate the price and negotiate terms a little bit better as well.
Yep.
So we'll skip that chart because I want to jump to this monthly indicator. And this is actually one that shows the amount of sale concessions to the price. So this is something that we track by downloading by Your Castle, downloading all the data from RE Colorado, which is our MLS, and then tracking the field in the closing notes after property is closed to see what type of concessions have been given. So over the last 4 or 5 years, the typical concessions we've been seeing are about right around 30%. It's 30%, about a third of all transactions have some type of seller concession.
This is either a price reduction, seller concession towards credit, towards closing costs, some sort of repairs, something.
So that'd be like if Joe's a seller, and I'm the buyer, I come and buy Joe's house, and I'm buying the house at $400,000. And then we come in there and we do the inspection, and during the inspection resolution, Joe says, okay, yeah, there's a couple things that need to be fixed. I'll give you a $3,000 credit back at closing, so you can go out there and repair it on your own, do whatever you want with it. And Joe's like, yeah, I just want to deal with it, so here's $3,000.
Absolutely.
And that would count as a seller concession. And actually, let me change my number from 3,000 to 4,000. Keep the math simple. So Joe gives me $4,000 credit. 4,000 of 400,000 is 1%. So a lot of times, look at the last couple of years, we're seeing for the houses that do have concessions, we've been seeing right around a 1% concession amount. So my example there, 4,000 on a $400,000 purchase, is that 1% of concession.
Right in line with the normal market.
Yeah. But what's really interesting now is we're still seeing about 1% concession to sales price. But now in this last quarter, at kind of like Q4 of last year, creeping to Q1 of this year, we're seeing a huge jump. So I'm going to read just some numbers off of these are percentage of sales with concessions. So starting back in 2017, this is quarterly data, 34%, 30%, 32%, 36%, 33%, 34%, 37%. That was 2017. Excuse me, at 2018. Now in Q4 of 2018, it crept up to 41%. It's the highest data we're seeing since 2015. Now in Q1 of 2019, we're at about a 58% of properties with sale or property sales that have concessions. But again, we're seeing about the same roughly percentage of price to concession amount, which is right around a 1%. So Joe, how do you interpret that data?
I'll tell you, I think it is sellers being nervous after last year in the fall. Right here, right, late third quarter, we had interest rates that really increased, and that slowed down buyer traffic. I guess it would have been, August, so mid third quarter. That slowed down buyer traffic. Sellers all of a sudden went from 5 days of inventory or less than, not 5 days of inventory, but 5 days on the market to 10 days on the market, 12 days on the market. And everybody freaked out a little bit. And I think it was a time that sellers said, oh my God, we're finally under contract after 2 weeks. We don't want to let this contract expire. So we're going to be willing to do something. They want something on inspection? Fine. We're happy to do it. And I think that sentiment has carried over that now, hey, I'm under contract. I don't want to lose that buyer because my neighbor canceled on someone back in December and then they sat on the market for another 60 days. I don't want that to happen to me. So you've got somebody that wants $2,000 in seller concession. Fine. I'm happy to do it. And I'll give you my own example. I sold my property back in February, a home that I had lived in for 10 years.
February of 19?
February of 19. Yeah, just 4 months ago. Came in and there was the windows were dated, right? You had some fog in some of the windows and they came through, they did their inspection. They found 1 or 2 things. And one of the things they said is, hey, we want these 8 windows replaced. And I said, I don't want to deal with that, but I'm going to give you I'm going to give you $2,000 credit that you can replace the windows on your own time because I would like to stay under contract and close. And they were like, fantastic. Yeah, sounds good. It was a $500,000 sale. So what's that? 0.4%. I was thrilled to give them the $2,000, not have to deal with it, continue to move on, sell the property. So instead of netting $500,000 total, I netted $498,000. I had to pay off the mortgage and miscellaneous stuff, but net price $498,000. I was happy as could be. I didn't have to go back on the market. I didn't have to relist it, worry about showings again. Happy to do it. And I think a lot of sellers are seeing that back here, sellers had all the power. Hey, you don't like the property as it is? Screw off. We're not going to deal with you here. I think this is appropriate. Let's be a little more reasonable. We got somebody that wants to buy it. We want to sell it. Let's work together.
Yeah, and I'm seeing the same thing. Again, I do mostly the buy side of things, but I don't track every transaction specifically, but just, looking at things is we are definitely getting a lot more concessions per amount of properties that we are buying. And it's the same thing. So even like Joe's case, which is a very common example we're seeing now. Last year, people said, no, you either take this or leave it.
Yep.
Because most parties like, okay, I'll just take it because I don't want to have to put in like 5 more offers to get a place. But now sellers, and again, I just sold my property in Reno, Nevada. I gave like $500 in repair and a credit for repairs. Yep. I mean, for $2,000, it's not worth the time of putting it back on the market. Because honestly, it's going to delay the closing another 30 days at best.
Right. You got to make another payment.
That's another mortgage payment.
Right.
Cool. You're still coming out ahead and it's way less hassle.
Right. And you know what? I didn't move very far. So I'm still the person's neighbor.
Yeah.
I wanted her to have the house. I want her to be happy for $2,000 and we can smile at each other when I drive through the neighborhood. Fantastic. Thrilled.
So again, I think this is a really good thing to see that, hey, it's becoming a little bit more, I should say, not more buyer friendly. It's becoming less seller friendly, because it still is definitely the sellers are driving the market. But if you're a buyer out there now, you got a little more inventory to look at. You got a little more breathing room, and you can actually get some wiggle room on inspection items to get some credits or some repairs back as well. All right, so we're going to move from our market data onto our first case study. So this one, let me read my slide for a second here. Yeah, okay, so this one is a house hack that we helped a client get in Arvada. So I was on the agent side, Joe was on the lending side.
Yep.
And this is actually fairly close to Old Town, just probably a little bit, let's see, northwest of Old Town. It's a 4-bedroom, it's a 3-bathroom place, and we got right around $430,000, give or take a few $1,000s. So this is a couple that's looking to house hack, and I think this was the 3rd or 4th property. I think it was a 3rd property we put an offer in on. The first 2, we didn't win them.
Didn't work out, yeah.
And that's the way it works sometimes. And looking back, I'm glad as the agent, and they're glad as a client. Hey, this property is better than the first 2 or 3 properties we put offers in on. So we're all happy. Yeah, it took a month longer, but no big deal in the 30-year grand scheme of things. But here's why we liked it. Number one, it's a good price point that still makes sense for house hacking, around that $400,000 price point. It's in Arvada, which is a great location. I think there's tons of upside there. Lots of people are moving there. So like the area a lot, plus being near Old Town, like, cool. That's a huge, huge benefit there. But specifically about the house is it's got this amazing layout. And what this layout does, you come in from the front, or from the front, looks like a normal house. It's got the garage. It's got, some living space. It's got a little, some living space above the garage. Just looks very typical looking from the outside. You walk in the front door, and there are, I think it's 3 bedrooms and 2 bathrooms in the main part of the house. Basically, it's all kind of ranch style in the main part of the house. So you walk in, living room, kitchen, and I think there's 3. It's either 3 bedrooms or 2 bedrooms, one or the other. 3 bedrooms and 2 bathrooms. So great layout. But then if you walk through the kitchen, walk through the dining room, you go out this other door. It's an interior door, but it's a heavier duty interior door into a small hallway. In this hallway, then there's a separate entrance to the backyard, which has a path that goes around the garage to the parking. What am I trying to say? The driveway out there on the front.
Yep.
Man, I need more caffeine this morning. So it has a separate entrance. And then also, when you come into that separate entrance, you go up the stairs that actually go over the garage into a living space above the garage. And the space above the garage is really, really cool. It's got a big open living room, living space. It's got a small kitchen in there. Then it's got a bedroom, and it's got 1 bathroom up there. So I think the previous owner, it was an estate sale we got it from. I think she lived there for a long time, and she ended up, I can't remember, I know she lived upstairs, the main floor, but she rented out the other unit. It's still single family, but they're almost like 2 separate units for all living, for all practical purposes. So it has this great layout that's perfect for house hacking while they're living there, and gives them more options once they move out in a year or 2 to converting it to a long-term rental. So again, awesome layout, separate entrances, separate living spaces. And even if one of the sides of the houses is they're having a party, they're staying up late or whatever, the other sides, I don't think they're going to know, because they're separate. And the one's above the garage, the other one's next to the garage. So it's a phenomenal layout. So what the house hackers' plans are to do is they're doing some very minor updates. They're redoing the bathroom up in the smaller space above the garage. It's very dated. The guy, he's hands-on, so he also just wants a project to update it. So they're updating that. I think they're doing a few other small things, like they're putting a deadbolt on that interior door, separating the hallway with separate entrance to the main living space. And then out back, they're going to put like one of those touch keypads for unlocking and locking the door, because their plan is to actually live in the main unit or the main part of the house, rent out one of the rooms to a family member, and then they're going to Airbnb out the other living space that's above the garage. So that's the plan. It's a phenomenal property. These are properties we love funding out there as house hacking, and we have our searches and ways to kind of comb through the MLS to find them. And we found this, we find ones like this. So we're very happy, and our clients are very happy. So what this is right here is actually we're going to walk through some numbers before showing you the spreadsheet. And Joe, this comes from you. This is the has all the terms on here. So I'll let you walk us through this and tell us what's going on.
Yeah, so this is the closing disclosure. They put 5% down, so we loaned them 95% at, guys, still a super low interest rate considering you're only putting 5% down. Here's the principal and interest payment. Then we've got to factor
read those numbers off. He's going.
Oh, right. So sorry, I keep forgetting. People can't see this. So
they want to hear your voice,
right?
Man.
I'm fantastic. Paid $430 for the home and new loan amount of $413,000. Interest rate right at 4.5%, and a principal and interest payment of $2,093. Now you'll notice it's a 30-year fixed rate, so no changes on the payment, no prepayment penalty. And then they will have mortgage insurance for the first 10 years, and that mortgage insurance is $220 a month. And then taxes and insurance of $253 on the property for a total payment $2,567. One really cool thing down here, this is where homeowners associations would go. There is no HOA. So I think this has a pretty good sized backyard, which would free them up if they, wanted to make additions to the property in the future, do an additional, add square footage or things like that. There's a lot of opportunities that they don't have to get a lot of permission from the HOA. Total cash at closing, they invested $21,000 into this property. So not a ton of money out of pocket to get, very reasonable payment on a $430,000 home.
And is that cash to close? Does that include the earnest money they put down, or is that?
No, this would be net of the earnest money.
So the earnest money would probably is usually like $5,000, $5,000, maybe
right.
$7,000 on a property like this.
Yep.
So one thing, I'm actually going to go on the next slide because their closing costs are $10,000 and change, which are typically higher than we estimate.
That's right.
So I'm going to go to the second page here so you can explain why we're seeing some higher closing costs.
Yeah.
Because they actually did a few things to help with their monthly payment.
Yep. So a couple things. Number one, they opted to buy down their interest rate, pay a little bit of extra cost to have a little bit lower rate.
So what that cost them? What point buy down they get?
They bought down 0.875%, which decreased their interest rate from about 4.75 down to 4.5. Now, a lot of folks might be saying, "Oh, wow, 4.75, that seems high." Well, you got to keep in mind, everybody's situation is different. This is only 5% down. Sometimes you have a little bit higher credit, lower credit, lots of variables that go into it. One of the other important things that we did in order to get this property under contract, right here, appraisal. They paid double for their appraisal, which factors into that, so that they could get this appraisal completed in less than 3 days. Now, the reason we did that was in order to get the property under contract. I'm pretty sure we did a 2-week closing on this. And so we wrote the contract and said to the listing agent, "Hey, we're going to have the appraisal back within 3 days of you accepting this offer. Now, we're going to pay more for this appraisal because we want it back, because we want to take away any uncertainty from you, Mr. Seller, on whether or not this property is going to appraise at the contract price." So the buyer was very smart, that they understood the value of paying a little bit more money for an appraisal allows them to get the property under contract as compared to 5 other offers that wanted 30 days, 45 days, etc. All right. So I thought that was a great strategy. I've used that a number of times. What do you think about that, Chris?
I like it. That's why we use it, because speed matters.
It does.
And I mean, hey, put yourself in the seller's shoes. If you're coming with a good, strong offer, you can close fast. Cool. You look really, really attractive. And I mean, probably about $600 more to get the appraisal. Yeah, I know. Hey, it's another $600 out of your pocket right now, but it helps you get a great property. In the big picture, it's worth every penny.
Absolutely.
So yeah, we had some higher closing costs because of the appraisal, and they bought down the loan points. And this is one of the reasons why I always refer clients over to Joe and say, if you're house hacking, you need to talk to someone who understands this, because this is where different levers you can play with on the loan side of, hey, should I prepay PMI? Should I not prepay PMI? Should I buy down a point? A lot of times we do these things, which actually have a much bigger impact on the monthly expense and therefore the monthly cash flow, than by reducing the price by $4,200.
Right.
That's going to reduce the payment. $20
about $20. Yep.
Which is not going to make a difference.
Right.
This right here reduces the payment. I don't know, but a lot
about
more.
$80.
Yeah.
Yeah. About $80.
So, obviously we play around with those things. That's one of the things that Joe does with his clients. So out of those few more closing costs in there, all this other stuff is just
title
the
insurance
stuff.
Yep, you have to pay title insurance.
Yeah.
You've got to have insurance guaranteeing there's no liens or judgments on the property.
So kind of all the standard stuff,
homeowners insurance, property taxes, prepaid interest. So one thing to remember too, you're always going to have interest from the day you close through the end of the month. But these guys did not have a payment on May 1st. First payment didn't start until June 1st. So they get, basically a month and a half with no payments. And then setting up their new escrow account. So just like any other transaction, you're always going to have taxes and insurance included in the monthly payment, which is important.
All right, so let's dive into the spreadsheet now, since we kind of gave you guys a picture of the clients, idea of the property, and ran through some basic numbers. So I'm using, these are some screenshots of Joe's rental spreadsheet. And you'll see actually selected 2 units up there, which technically it's not, but that way we could just have the different rents for the main part of the house and the kind of mother-in-law suite part of the house.
Yep.
We put 5% down, and you'll see there's big red letters that say warning, borrower needs more down payment. That's because this is more of a rental property spreadsheet, not the house hacking one. We got the right around $430,000, and I put in a negative $2,900 in acquisition cost. And that's just because I had to kind of fiddle with the spreadsheet to make the numbers work, because the loan cost came out to about $14,000. That's because Joe built it saying, hey, if you're buying investment property at 5% down, you got to pay way more fees.
Got to pay a lot more costs.
Which we're really not doing.
Right, because this was this was an owner occupied. Yeah,
so if you're looking at the spreadsheet later and saying these numbers, I did that just to offset it, to kind of bring it back down to about that total right around like whatever, 10,000 and change in closing costs. So they work out in the long run. And I put $3,000 in for the initial repair costs for like that bathroom remodel and a few updates that I think they're going to do most of the work themselves.
Yep.
4.5 interest rate. And what they're doing, I said in unit 1, that's the main part of the house, is they're actually not going to, the couple's not living in the master suite. They're living in the other bathroom or the other bedroom, because that's just a bigger bathroom, double vanity. And so they wanted that. And they're renting out the master suite for $600, which is below market rent. Market's probably $800 to $900 for a room in that part of town, and that nice of a room and nice of a house. But they're renting it to a family member, so it's easy for them, easy for the family member, and it's just kind of a win-win. So they're actually, hey, they could make more money, but they're keeping life simple and helping a family member, and they obviously they know what roommate they're getting, so it's worth a little bit less money a month to get along really well with their roommate. And what their plan is, they're actually going to Airbnb the other part of the house, like the mother-in-law part of the house. And based on some numbers, I don't think they've actually started Airbnb-ing it yet, but they're looking to probably bring in about $2,000 a month in gross income from Airbnb on there. That's a great location near I-70, near Old Town. And so I put $1,700 a month in there to kind of account for the Airbnb fees and some taxes. They're going to do the cleaning themselves. They're going to do all the stuff themselves to put in that sweat equity to get every dollar they can from it. So obviously, when you look at Airbnb income, it's not going to be $1,700 a month, and there's a lot more expenses and variables to play around in there. But while they're living there, we are estimating that they're bringing in $2,300 a month in rental income, which is kind of nuts, because if you go out there and want to just go rent a 4-bedroom house out there in Nevada, a lot of times their rent's right around $2,300 a month, and they're going to bring that in while they're living there and actually having a really good setup.
Yeah, pretty amazing. I mean, really, it only costs them, what was the payment? $25.50.
Yeah,
cost them $250 a month to live there. I mean, that's amazing.
Yeah. And kind of going into the annual operating data, read these numbers. So taxes about $1,450 a year, property insurance about $1,450 a year, repairs and maintenance, I think we put at 8%, about $2,200, water, sewer $1,500, trash $300, electric $2,000. I really ballpark these. I'm not sure how they're splitting things up with their roommate / tenant. So, those aren't going to move the needle that much if they're a little higher or lower. And then the last expense is PMI, which is about $2,600 for the year. So moving on to what that looks like is their annual cash flow before taxes while living there with all of that included is about $9,600 a year negative cash flow. So that's about $800 a month they're paying to own a house and live in a house and build equity. So for $800, what can you do with that? You can go rent a room somewhere in Denver for $800 a month.
Yeah.
So they're basically the same cost they'd caused to rent a room. They now own a $400,000 asset in a great market with long-term upside. So they're going to be living for about $800 a month. Now, they could definitely live for cheaper by charging more for that roommate to their tenant and actually getting one more roommate in there, but they don't want to. This is where it becomes that balancing act of, hey, we want to make sure we enjoy while we're living there and also bring in some income. So they could live for free if they wanted to, but they'd rather have more privacy and a higher quality life than save $800 a month.
Yeah, which is smart. Sometimes your mental well-being is valuable.
Yeah. I mean, at this stage of my life, I would pay that 100%.
Absolutely.
So moving out and I think their plan is to stay there for about 1 to 2 years. I don't have a definitive timeline, but probably 1 to 2 years. So when they move out, I put some numbers in there for long-term renting. I think I'm actually really low on both. I said $1,700 for the main part of the house, when it's probably more like $2,000. I'm not sure why I put 1,700 in there. I must have had some good reason last week.
Well, a 2-bed, 2-bath, or 2-bed, 1-bath is the main area. That's probably about right.
No, it's 2-bed. It's either 2-bed, 2-bath, or 3-bed, 2-bath in the main area.
Oh, okay.
Yeah,
yeah.
So I think I'm a little low, but better to be conservative. And then I'm assuming when they move out, they can rent out that mother-in-law suite on a long-term basis as well for about $1,100 a month, which I think is, when they move out doing Airbnb, it's a lot harder and not allowed. Assuming it's long-term rental for both of those, all the expenses will stay the same. I dropped off some of the utilities, and they're going to be at an annual cash flow before taxes of about negative $2,200 a year. So this is once they move out, negative $2,200 a year. So a couple things to consider when you look at that number is obviously the rent will have a big impact on there. If they can raise that main floor's unit by $200 a month, cool. They're at neutral cash flow now. Also, this negative cash flow we're looking at $2,200 a year is not taking into consideration the tax benefits of depreciation once they move out. Depreciation, which is a wonderful tax benefit the IRS gives all property owners, that tax benefit should offset that negative cash flow. So it's kind of, it's getting money out of your left pocket versus your right pocket type concept. We normally don't talk about that, but it's a really important concept to understand. So I think rent's a little bit low. We're not accounting into depreciation. Plus, in a year or two, this is using rents from today. Well, in a year or two, what do rents usually happen, Joe?
They generally go up.
Yeah,
in my experience.
So are they going to go down? If I had to bet, most likely not. So there's a good chance rents will even creep up a little bit more than we're assuming now. And the other thing is their PMI is about $2,600 a year. Their annual negative cash flow is about $2,200 a year. Well, if they drop off the PMI, because there are strategies you can do to drop it off early, which we won't talk about now because that's a rabbit's hole. But I've got some clients after 2 or 3 years, they actually drop off the PMI or able to drop off the PMI. Or if they have to wait for the 9 or 10 years, whatever, for it to drop off, cool. It's going to drop off at some point. It's going to help out their cash flow. So, of course, we'd always like to see positive cash flow. But when we actually look at the bigger picture of a very low down payment, I'm being conservative on the rents. We're not taking into account depreciation, and we got PMI in there. This is a slam dunk deal for the Denver real estate market in my mind. Now, of course, start with my clients. You got to understand these numbers, understand all these other factors, and not just look at cash flow. That is a very simplistic measure, and there's a lot more to building wealth in real estate. Because what are the alternatives? Oh, I don't like this. I'm not going to buy it. Cool. We'll sit on the sideline for 5 years or 10 years.
Right.
Or rather than paying $25,000 for this house, saving up $25,000 takes some time, but it's doable. Hey, if you don't want to, save up $100,000 instead. Personally, I'd rather have a little bit of negative cash flow and spend 30 grand than spend 100 grand to make a few $100 more a month.
Right. All the negative cash flow it's just deferred down payment. All right. Because you got to think about it. I could have put 20% down, or this client could have put 20% down, and they would have positive cash flow on this. That negative cash flow of $2,200 a year, they only put 5% down. That's just deferred down payment. They're just spreading that 20% down over a certain period of time, 1, 3, 5, 7 years, until the rents catch up and cover that amount of down payment that they didn't make.
And another way to look at it is, your tenants are subsidizing your down payment, and they're actually paying for it.
That's right.
Which is a really cool thing when we actually dive into the numbers. So of course you guys have to be comfortable with this, but we actually try to dive into all the numbers and some of the various details on you to kind of give you that bigger picture and a better way to analyze properties. So, Joe, any final thoughts on the house hack before we move on to number 2?
I think it was a great transaction. I hope they're very happy with it. I think they're going to make a lot of money.
Yes. They have that property for 20 or 30 years. Yeah, they will
make a lot of money.
Cool. So the second property we're going to look at is actually a rental in Aurora. So this is a non-house hack. So a lot of times we try to do like one of both to kind of give you guys some perspective. So this is a condo in a complex that we have bought many, many properties from over the years. It's actually out in East Aurora, not too far from Buckley Air Force Base. So it's a 3-bedroom, 2-bathroom condo, and it is a very investor-heavy complex. I mean, you probably see it's probably got to be 80, 90%.
I think it's 80% investor concentration, if not more.
Yeah. I mean, so it's a very, very heavy investor concentration there. So our purchase price is right around $190,000. So, well, why would we buy a condo? Well, because if you're looking for cash flow, condos are the best cash flowing property, generally speaking, right now in the market. So we can't change the market. We can just adapt the market, and we're seeing the best cash flow in condos right now. So we bought it for right around $190,000. Now, what we're going to focus on this transaction, which is different from a lot of times we've talked about rentals in the past, is that the client actually paid cash, and it's cash that they took from their HELOC from their primary residence. So I'm not sure quite when they bought their primary residence, but it was a number of years ago. And they got the gift that the market gave a lot of people that buy property 5 years ago, is you've made a ton of money in a ton of money. Your property appreciates. You got a ton of equity sitting in your property. So some people say, hey, that's great. I'm happy to have that. Other people say, great. That's dead to me. I want to pull that money out and make it work for me. So he's pulling money out in the HELOC at, I don't know what, 4 or 5% or so. I don't know what the terms are, but that's, I think the HELOC,
HELOC right now is about 5.5 to 6.5%.
Okay, 5.5.
Yeah, 5.5 to 6.5, depending on your.
And you can do a HELOC or a cash out refi. I'm actually not sure which one this client did, but
he did a HELOC.
He did HELOC. Okay, okay. So I worked on the buy side as an agent, and Joe actually did the refinance after the property was purchased. So he pulled cash out to buy the property for the reason we did the fast appraisal in the first house hack. It's because it's speed. We had put an offer on, I think, 2 other properties. We lost out. So we said, hey, let's go with a cash offer versus financing just to do a quicker close and make it a sweeter deal. So we went there with the all cash offer, really good offer, with a plan for him to refinance with delayed financing with Joe after the property closed.
That's right.
And we'll go into details about how delayed financing works, because this strategy works really well right now if you've got the cash, or most likely probably got the equity sitting in your house somewhere. So, Joe, here is the CD again. I'll let you walk through on this. Because it was about $190,000 property. And since it is an investor-heavy complex, he has to put 25% down to get the good old 30-year fixed.
That's right. And keeping in mind, too, because this is a cash-out loan, delayed financing, you can borrow up to 75%. So 75% of 190 is $142,000. Interest rate, 5.6, a little higher because it's a condo. It's an investment property. It's not a primary residence. That payment, $820 a month. Again, 30-year fix, never going to change. They opted not to do escrows. They pay that on their own. They pay their HOAs on their own, no problem. You can look down here, closing costs super low, $4,700, and they walked away with $138,000 cash. So this is a transaction or a type of loan that we offer. And this is about 2 weeks after they purchased the property. So they paid cash for the property, and then we can give them up to 75% cash back that they can use to repay that home equity line of credit. All right. So they repaid the majority of the home equity line of credit. Now that difference, that 25%, they've either got to pay that off on the home equity line of credit, take it from savings, whatever, or just continue making payments on the home equity line of credit. But by putting this $138,000 back on the HELOC, that frees up that HELOC that they can then use this $138,000 to buy the next property if they want to.
And so, Joe, what's the difference between refinancing and delayed financing?
So refinancing is paying off an existing loan or maybe taking cash out on a property you've owned for a certain period of time, 6 months, a year, 2 years. Delayed financing simply means you paid cash for it, and now we're taking that cash back out with no seasoning requirements. Not every lender has
What's
this.
seasoning?
Seasoning is how long you need to own the property before you can get a new loan on it. So for delayed financing, we don't have any requirement. You can own the property for 1 day, and we can help you refinance it and get cash back out the very next day. But we just have to verify you paid cash for it. It's your money, right? You didn't borrow money from mom in order to buy this property, right? It was your cash, and we'll help you do a cash out delayed financing loan with no waiting period from the time you close.
All right. So if you guys are got the cash right when you do it, this is a really good strategy. Go out there and pick up properties, and you can actually not refinance. You can do delayed financing right after you close. And so it's a really good way to get properties and then get the benefits of real estate, which is using leverage to buy and own the real estate, because that's where you make a ton of money, is through the leverage aspect of it. So this is a second page of the CD. Joe, walk us through some of these fees associated with doing delayed financing.
Sure. Just like our last transaction, they opted to pay 1 point to get a little bit of a lower interest rate, flat cost to process and underwrite the loan. An appraisal on a rental property is always a little more expensive than a primary residence, $700 as compared to normal cost for an appraisal of $600, simply being because they have to do a rental comparison as well. It's more work for the appraiser. And then title insurance is actually a little bit cheaper on a refinance as compared to a purchase.
Why is that?
You already own the property, so you've already paid for that owner's title policy.
Okay.
So now you're just ensuring for the lender that there's no additional liens, bankruptcies, or judgments on the property. So very low, total cost of $3,800, or I'm sorry, $4,500, including the appraisal. So very, very low closing costs on a transaction like this. And then really nothing for taxes and insurance. They're paying that on their own.
So when they do a delayed financing, they've got the option to pay that though, but not do it through escrow?
Correct. Anytime you're putting down greater than 20%, you don't have to include taxes and insurance in the loan. So whether it's a purchase, refinance, if you're putting greater than 20% down, you don't have to have escrows if you don't want to.
Oh, I did not know that.
Yep.
Look at that. Learn something new every day. So here is the numbers plugged into Joe's spreadsheet. So Aurora rental, 1 unit, 25% down. We're put it as a down payment. Conceptually, the same thing. $190,000 to purchase it. We about $4,500 in acquisition cost. About $5,000 actually. Interest rate at 5.625, and the rents over there about $1,850, actually $1,800 to $1,850 is the going rate for Section 8, paying rent in a 3-2 property in Aurora.
Can I pause you for 1 second?
Yes.
We hear all the time people are like, "Oh, I'm looking for that 1% rule, right? I want 1% of the monthly rent, or I want 1% of the purchase price to be the monthly rent." And a lot of times it's difficult to find. This is pretty darn close. Pretty darn close, guys. And there's more properties available in this complex. There's more properties that we find like this. I think that 1% rule is kind of just a thing that people like to focus on. I don't necessarily think that that's a definition of a good rental, but if that's your thing, check it out, guys. Pretty darn close. This is like a 102, 104 GRM. Really, really close to that 1%.
Yeah, I think it's either the third or fourth property bought in the complex this year. So they turn over. And we like them. We know the complex. I mean, we know way too much about the complex.
That's right.
I mean, in a good way. In a good way. So taxes are about $950 a year. Property insurance about $300 a month.
$300 a year.
Yeah, sorry, $300 a year. Thank you. Property management. He is self-managing, so our cap rate numbers are not including property management costs. Repairs and maintenance, we generally use 5% for condos and townhomes, so about $1,100 a year. And the HOA dues about $3,600 a year. So a lot of times people say, I will never buy a condo or townhome because of an HOA. So people either love them or hate them. I'm indifferent, or I tend to like them because it's all pros and cons. It's not just, oh, they're horrible. Yeah, you give up some control. It is a different expense. But some of the pros to that is that your property insurance is usually much, much lower.
That's right.
Your repairs and maintenance and capital expenditures are much, much lower because the HOA is taking care of roofs and exterior and siding and sidewalks and lawn maintenance, stuff you don't have to do. And I think if you're so much easier because you don't have to worry about who's cutting the grass,
Snow
who's
removal.
removing the snow, who's going to slip on the ice and then break their arm and sue you.
Yep.
Like, it's all pros and cons. So don't totally rule them out. Understand what are the pros, what are the cons. It may or may not be a right fit for you, but there's no blanket. Yeah, you should or should not buy those. It's all pros and cons.
That's right.
So going into the numbers here, the net operating income, which is rents, or the total annual rents minus the total annual operating expenses, not including the mortgage payment, was about $15,500. You subtract out the annual mortgage payments, about $9,800. We're at an annual cash flow of about $5,700 a year. So that's the 11% cash on cash return and an 8.2 cap rate. And as Joe said, it's about a 103 gross rent multiplier. So that is about kind of the best deals you can find right now in Denver without doing some crazy rehab or burring or knocking on doors.
Yep. And this was, where'd you find this property? You had to talk to like 15 wholesalers, I think.
I had to actually check like 15 emails to delete to get down to my daily MLS feed to read this email.
Yeah.
So it was hard work.
We're joking, guys. This was on the MLS. It was on the shelf, just like going to Target. It was right there on the shelf. You just pick it up. There it is. So people say there's no deals in Denver. This is a smoking deal, guys. This is a deal that's going to generate 20% year over year after taxes for the next 5 years. This is the type of property you want to buy. And it was on this fancy service called the multiple listing service, right? Available for any person to purchase. This client, I think, was great. They were fantastic to work with. And Chris was a fantastic agent to find this transaction for them. So great deal.
All right, so that wraps up our second case study here. So we do have some upcoming classes and webinars. We're actually teaching a house hacking class next week. That's a live class in person here at the Your Castle office. That's Tuesday, May 21st at 6 p.m. And then Wednesday, May 22nd, we're teaching the course on how to use Joe's spreadsheet to analyze properties. That's Wednesday, May 22nd at 12 p.m. House hacking is about 2 hours. Property analysis spreadsheets about 1 hour. And then June 4th, how many properties do you need to retire? So the property spreadsheet is more of a beginner level class, which everyone should understand and go to understand how to analyze properties. House hacking, if you're interested in house hacking, this is a class to go to. If you're in a position in your life where you can't house hack, don't come to it. But if you want to house hack, this is a great place to learn, network, and we usually have great audience participation of other house hackers in the first, second, third house hack, giving in their real-time feedback, pros and cons of what's going on right now. So it's a great one to go to. And then how many properties do you retire? I would classify this more as towards an advanced class because you need to understand the basics of analyzing properties because we move fast and we actually say, hey, here's how many properties you need to retire for this amount of money to retire at $10,000, $15,000, whatever it is. So make sure you have the fundamentals down because we kind of reverse engineer. Cool, your target income is $10,000. Here's what we need to do to help get you there. So check out those classes and other classes and webinars at denverinvestmentrealestate.com/calendar, and I'll take you to the calendar link. All right, guys. Well, thank you for listening and coming out. Again, my name is Chris Lopez. I'm an agent here at Your Castle Real Estate. So if you need help buying a house hack or buying a rental property, definitely reach out to me. That's what I specialize in. That's what I love doing. And if you need help with financing, whether it's on the purchase side or doing delayed refinance or delayed financing or a cash out refi, reach out to Joe Massey at Castle and Cooke because he is great at what he does. So our contact details are on the slide. And of course, they'll be on the show notes. So, Joe, thank you for your time again.
Chris, always great to see you, man. Really enjoy these webinars. Folks out there, anything we can do to help you, call, text, email, send a carrier pigeon, smoke signal, whatever. We would love to chat with you. Love to talk about how we can help you with your real estate goals. Have a great week, great month, and we'll see you guys next month on the May Roundup.